Hi and welcome to the pittrades.com educational video series. In this series we're going to talk about figuring risk, and the best way I can give an example of what it means to understand risk is like baking a cake. If you bake a cake without maybe the eggs, okay, the cake probably will not work out very well. And it's the same thing in your trading. If you don't understand your risk and how to manage it and how to size it, then your trading probably isn't going to work long term. So let's get right into this. We got a lot to cover. Now, before you can actually figure your risk, you got to understand what you're trading. In other words, understand your product. All right, whether you're trading equities, options, or futures, understanding what you're trading is important, especially when it comes to the tick values. So in this case, I give an example of the futures, the minis that a lot of people trade, and we'll focus on the S&P mini. All right, now we know the futures actually trade in contracts, and there's 4 throughout the year for these products: March, June, September, and December. And here's their symbols: HM, U, and Z. Okay, now the actual trade symbol would look something like this. Would be ES, which is a symbol for S&P mini. Z would be the contract month, and of course 1 would signify the year. In this case it would be 2011. So this symbol that we're actually using, because we just rolled into it, is ESZ1, which is the December contract. Now this is actually traded on the Chicago Mercantile Exchange, which is owned by the Chicago Mercantile Group. And of course, more importantly, each tick, okay, or one tick increment is worth $12.50. Now 1 point is equal to 4 ticks. So 1 point in this index or this future would equal $50. Okay, and that's important because we'll use that to figure our risk later down the road. All right, now you've heard this all before. Hold your winners, cut your losers. We've heard it over and over and over again, but nobody really shows you what this means. So let's take a look at what this actually means and also what it looks like so you can understand it and why it's important. Now, we're going to give you an example here of a system that only wins 30% of the time and loses 70% of the time. Now, you may ask yourself, how is that possible? How can somebody lose 70% of the time and still make money? Well, it's possible with good risk-reward management, and again, letting your winners run and cutting your losers short. Okay, so in this example here, we're going to use 10 trades. Now, when you're testing your system and trying to see if it's going to work and actually what your win-loss is, then you're going to need a bigger pool. You know, maybe 100 trades, 200 trades, I don't know, whatever you're comfortable with. But in this case, we're going to use 7 trades. All right, now the first, 10 trades, and the first 7 trades are going to be losers. All right, now we're using a 3-to-1 risk-reward ratio, which means we're risking 1 unit to make 3 units. On this case, the 1 unit is going to equal 2 points. Okay, so we have 2 points of stop, and we multiply that times 7 trades because we stopped out 7 times. That equals 14 points of loss. Okay, on our last 3 trades, they're winners, and when using again the 3-to-1 risk-reward ratio, we know that our last winners are worth 6 points. So trades 8, 9, and 10 are worth 6 points each. So that's 3 trades, and that equals 18 points. If we take 18, subtract the 14 that we lost, we get a total of 4 points of profit. 4 points of profit times $50, which is what? $50 is 1 point move in the ES. That equals $200 of gross profit. Well, that's how you can make money having only 30% of your trades winners. That's risk reward, understanding that you're risking less and winning more. In other words, holding your winners and cutting your losers short. Okay. Now this also assumes in this example that we have an all-in, all-out entry-exit technique. Now there's a lot of different entry-exit techniques, but in this case we're only using all-in, all-out. So let's quickly review here. You need risk reward measures in your trading. Bottom line, if you don't have it, you're probably trading with one arm tied behind your back. Understand what your product is, whether they're equities, options, or futures. Okay, and also understand what it means to actually hold your winners and cut your losers short. Okay, in other words, risk reward. You got to be risking less and earning more. In other words, you can't be trading multiple times in a day trying to scalp and stuff, because that's not a winning system in the long term. It may work in the short term, but not in the long. Now, in the next video series, we're going to talk about calculating risk and sizing. So stay with us here. Hope this helps, and we'll talk to you on the next video.